Was gonna fish today, but it's awfully breezy out there. I tend to throw a spoon because I find the spoon to be one of the most interesting things to use off the beach because you tend to see the more aggressive fish really come after and chase that spoon down. Plus it's just easy to maintain and everything else rather than trying to put live bait on. That's something I'll fly out with my drone and really catch something quite entertaining like a small shark, a bull shark, or things like that. So what I was doing here today was I was gonna fish, but however, I'll give you guys a video here, kind of a recap, some of the things that I'm looking at in the precious metals and in the commodity spaces. So what an incredible week it was in commodities with volatility across the board in most asset classes and sectors. There were 3 to 4 key events that really stood out over the past week. It was Fed Chairman Jerome Powell, his testimony, which was on Tuesday, the CPI data on Wednesday, retail sales on Friday, and then the tariff discussions that took place throughout the week. It almost seems like no commodity was left unharmed without volatility in the markets because of the wild discussions about tariffs, reciprocal tariffs, and the speculation of tariffs hitting certain key commodities. So some takeaways here. The consumer price index, it did increase by the most since August of 2023. It further diminished the chances that the Federal Reserve will cut interest rates anytime soon. So what we saw was there was expectations for 2 interest rate cuts, basically like the May to June region and then the September to December. This hot CPI data comes out. They take away that front interest rate cut. They push out the other one out to December. Many of the large financial institutions, they took interest rate cuts off the board altogether. Now, after the CPI report, Trump orders his administration to consider imposing reciprocal tariffs on numerous trading partners. Causes a lot of volatility again in the markets. As you fast forward throughout the week, you get to retail sales at the end of the week, and it slumps by the most in nearly 2 years. It's indicating an abrupt pullback on consumer after their spending spree in the closing months of 2024. So that supports our stagflation case. Basically, you have this higher inflation, and then you got the consumer really starting to weaken, and they're really starting to feel it because of the higher inflation. So the market reaction, the bond market, it ends the week with some solid gains. The 10-year yield falls below 4.5%, and a soft reading on retail sales kind of revives those bets of a Federal Reserve cut. So the S&P 500 lifts up and gets close to its all-time highs, and the dollar hits a fresh low in 2025. So the tariff discussion, so President Donald Trump, he did say that he would implement new automobile tariffs around April 2nd. So he's really trying to he's pressuring a lot of relationships, pressuring companies to move production back to the US. One notable stock that I really watch, especially when it comes to automotives, is Rivian. So take a look at that stock. It's starting to kind of move up. Not a recommendation. It's just something that I like to look at. With many of the valuations and many of the stocks out there just trading at such high levels that a handful of different stocks kind of been on my radar here recently. So you look at the imports when it comes to automobiles. About half of the US imports on automobiles are made overseas, in Mexico, in Canada, things like that, and brought back in. So the announcement of those potential tariffs on automobile does shake up certain key metals and certain key commodity markets and causes that volatility. Now, getting into the commodity focus and looking at something like copper, which had a massive sell-off on Friday, down almost 3%. But if you look year to date, copper's up about 15%. So it was Trump announcing 25% levies on steel and aluminum imports, and he did mention copper, and that's when you look at copper and you see this massive move higher in that market throughout the week. It's because of the fact that there's speculation that he's going to impose those tariffs on copper. So what you see is domestically, copper futures are really bought up in all the outstanding copper within the US. People are trying to secure for whatever reason, whether they're just speculating on on price, or they need it as an end user. If you're a builder or someone who has to deal in maybe copper wiring and things like that, that's where you get this spread here between the COMEX and LME. It exceeded about $1,200 a ton. This is more than 10% of the benchmark on LME prices, and it's hitting a peak here that is the size of that squeeze that we saw last May in copper. Remember, copper futures took off, and then what happened to that? The delayed reaction was in the silver market. Now, the money managers, they really boosted their bullish bets on copper to the highest, and this was last week's data due to the concerns of the potential tariffs. You got hedge funds and other large speculators increasing their net long position by about 26%, and that's for the week ending of February 11th. And it's at the highest level, this bullish bet, since about 16 weeks. So that would go back into, last year when we saw that squeeze. So a red flag I had on Friday, and if you watch the video, the Metals Minute, I really came in and I saw a lot of different traders selling futures contracts across the board in gold, silver, and copper. And it was the gold market was kind of the canary in the coal mine, because you looked at the way the futures closed on Thursday and then you get into Friday. They're starting to close at their highs, okay? And you get this breakout on the silver market on the overnight session, but gold futures, they were unable to achieve a new all-time high. Now, if you rewind and you look at gold, something I'll do on a Saturday is I'll look at a weekly chart on the market, not necessarily the daily chart. The weekly chart on gold, it's up 8.5% year to date. This is a 7th consecutive weekly gain. It's its longest streak since 2020. It's helped by central bank buying. Also, China announcing that they're going to allow some of the insurance companies allocate about 1% towards gold. So they're going to diversify away from some of the property sector and things like that. And as a result, you see the bullish bets on gold, they continue to rise in the ETFs. Now, Friday's sell-off down about $51, which is a 1.7% decline. That red flag was that it did not post a new record high in the overnight session. So what you saw was a wave of profit taking, stop loss selling, short selling, and traders raising their stop losses. Many of these people have been in, and if you look at that weekly chart, for the last several weeks back to the upside. So you see gold fall the most. There's concerns over the tariff announcements, concerns about the Federal Reserve and then their interest rate policy stance. So you see the money managers, they cut their bullish bets to a 4-week low, and that was last week. So preemptively, people have been working their way out of the long gold position. Now, I'm not recommending to get out of long gold. I like gold to the long side right now. I think that 3,000 will become a self-fulfilling prophecy, and I think that will go up from there. If we do see a decline in the economy, the global economy, the impact of this inflation and tariffs really weigh in, like we're already seeing on retail sales, that the stagflation case could play out, that the Fed could start finally cutting rates and things like that. So you look at some of the option strategies that I monitor as well. What I'll do is I'll scan and I'll look for any kind of big bets on the markets. And one of the ones that I saw was April gold. Traders were putting on the 2,700, 2,650 put spread. About 3,000 lots traded there, which is an extremely bearish position. You're looking for a sizable breakdown for it to get back down to the 2,650 level. Now, on the inverse side of that, if you look at what people were doing, they were buying the May $3,000 call and they were selling the June $3,100 call against it. So it's called a calendar spread. And neither of these are recommendations. These are just observations. About 2,100 of those contracts traded. So you can see that people are playing this short term as a correction and long term as another bullish wave up. Now, markets that they do correct and they consolidate, that's often healthy for the sustainability of a long-term bull market. If you look at silver, silver's personality on the charts has been breakout, consolidate, breakout, consolidate. And that's how it's moved up. And it's those consolidations that really build this healthy, strong market. And they allow traders to come in and put their stop losses, manage their risk a little bit better than a market that just goes parabolic and straight up. Because traders, once they go with a parabolic and straight up market, they become scared that they're going to buy the top of the market. So you have scared money in there, and scared money just frankly doesn't make money. So what we want to look at here on silver is you look at Friday's range and you get into that high was 34.24, the low was 32.58.5. The volatility has really increased quite a bit, and silver's up about 11.5% year to date. The close at 32.65, slight red flag on here. The money managers, they are decreasing their bets on silver. They did take off about 2,000 contracts last week. Their net long position's about 35,000. Now on Friday, we did see this strong technical breakout, but if you look from January 28th, 29th, and 30th, what did silver do? It basically went up from $30 on up to about $32. That's that 2-week period coming after that. So after when you get to February 1st to about now, we get this dollar range kind of consolidation. I'm talking from where the open is to where the close is, about 32.18 being the open, 32.97 being about the close. Futures did trade outside of that range in its consolidation, where it got as low as about 31.61. Many people that are working with me were trying to buy 31.60. One benefit of having a futures account is that you can work good till cancel orders, and they work nearly around the clock. So at 2 a.m, China announces something, futures dip. You have that resting buy in there to hit that level that you're putting in. On the flip side, you can always work GTC sell orders on the upside. So that's something that is a real big benefit as well, because we saw that explosive move Thursday night and into Friday where silver futures broke out. A lot of people had resting sell orders as well in there. So letting the market do the work for you rather than on the physical side, if you're going to try and unload these things, it becomes just a bit more cumbersome. That's why I look at physical as a long-term asset to own here, where you're in this more for decades rather than shorter-term price swings. Now, I think that you look at the way we closed, and we closed on that low after exploring that upward size. A lot of traders did buy that breakout. I could just imagine broadly across the scope of all the traders that are out there. The problem that they're going to have is that if they bought the high and the account is under any kind of duress because of the sell-off, Monday is a bank holiday, so they're going to be unable to financially meet their margin call, so it may result in further liquidation in the market. That's why I'm going to practice patience. Many of you working with me had lifted quite a few futures contracts on the open. Again, on the video, you could see live on the video that people were calling in and they were actually selling their positions. Remember, on the futures account, many people, they're just in this for the bottom line. Are they making money or not on the futures? They're not in this for the physical long-term growth like what you'd hold with your physical gold and silver. They're in this just to capitalize on things. So what I'm going to watch out for next week here is another attempted move over, forget Friday's session, right? 33.18 on up to 33.21. Those were the previous tall ends of the wicks. I'm going to look to see if we could break out above there. I'll use some kind of method where if we trade over there for 15 minutes, 60 minutes, something like that, it might cause a little bit of, I'd say, concrete kind of proof that it's going to now make another test to the upside. You know, Dennis Gartman, he would say he would turn on his egg timer for 60 minutes once the market broke a level on the upside or downside to validate his thesis that we are truly breaking out. So I don't think I would necessarily go in and add the first time that we get the breakout over the 33.18 to 33.21. I would say I would be a little bit more patient and see it, make sure that it's not just probing some stops and coming back down there, and see if this market could break out, hold, and then start to push back higher. Now, kind of the risk management that I'll start to look at is going to be, you get the breakout, it holds there for 15, 20 minutes, whatever. Each individual person's slightly different on their perspective of what's a short-term, what's a long-term trade. And then I'll look at Friday's lows, Thursday's lows, Wednesday's lows as my critical line in the sand. So I'd say that pocket support line in the sand is closer to 32.50 down to 32.45. That's where I would not want to see the market go below. So right now, what I've done for you is I define my breakout level, kind of my rules around that breakout level, and then I put in my support level below it where I'd look at managing my risk below 32.50 down to 32.45. What I would not want to see is a close below the $32 level, because that might take silver futures to retrace that 3-day breakout to the upside. So that's all I got for you guys. Wanted to give you a video and some of my general thoughts on the markets. You got any questions on futures and option trading? You always give us a call here. And then I suggest that you register for the Metals Edge. Get a 2-week trial for that. And then also remember that futures and option trading, it does involve risk of loss, and it may not be suitable to all investors. Good luck and good trading.